Yes, sir. Good morning.
Yes, sir. Good morning.
Yes, good morning, sir.
Okay, thank you. Thank you. So yesterday, or in the last session, we had discussed about the contribution of various committees in the development of corporate governance in India. Today, we will be talking about the different models of corporate governance, and if the time permits, we will also discuss the various theories of corporate governance. And that will be the end of unit number 1. If we are able to complete unit 1 today, from tomorrow onwards, we will start with what we had decided. That is, directly we will be starting with unit number 5, that is case studies. So at the end, I'll give you 2 case studies that are to be discussed in the next session. So come prepared for those case studies. So models of corporate governance. 4 country model we will be discussing, that we had discussed in the last session also. I hope that if not everyone, many of you might have gone through with this model of corporate governance. So Anglo-American model of corporate governance, which talks about different levels. The highest level, of course, it is enjoyed by the board of directors. It is there in India also, it is there in the other countries, in many countries also. The same hierarchy we will see, that the highest authority which can make the policy decisions or any important decision related to the functioning of the company is called as board of directors. Here in India also we call it board of directors. Now, who elects the board of director? Of course, board of director is considered as the highest authority. Who elects the board of directors? Because board of directors are not called as owners of the organization. Owners are different. So owners here are the shareholders. So shareholders who are holding shares of the company, they elect the highest authority of the organization, and that is the board of directors. Now, the board of directors, they appoint the senior executives of the company, and in return, they expect accountability from these officers and managers. In the last sessions also, when we were discussing about role of corporate governance in India, there we had discussed that the auditors, the managers, the senior managers, they are accountable towards the board of directors. So whatever decisions they are taking, the department is taking, they have to take the accountability for that. That is very important. So appointment is made by the board of directors of the senior executives, and these managers or these senior officers are responsible, are accountable to the board of directors. Now, officers and managers, what they are supposed to do is leadership and internal control of operating activities. That also we had discussed that board of directors are not directly involved in day-to-day functioning of the organization. They are not coming regularly in the organization and observing how many have come, how many are performing, how many have achieved the target, how many have not. So they are not coming regularly in the company to check that how many are present, how many are absent, how many are performing, and how many are not performing. That is the job which has been delegated to the officers and managers. So it is their responsibility that they should lead the team under them properly. And there has to be internal control. Internal control means that these officers and executives are given the responsibility that they need to ensure that the employees are coming regularly in the office, they are performing their job which is expected in 100% manner, they are achieving their target. So all these things comes under the control, internal control and operating activities. Day to day activities is the responsibility of the managers and executives of the company. Now the company is on the whole, now board of directors, then shareholders of a particular company. Suppose the name of the company is company A. Shareholders have elected the board of directors. Then board of directors have made the appointment of senior managers and executives who are accountable towards the management. As well as these managers have a responsibility to carry out the day-to-day activities of the company effectively. Company A, for example, company's name is A. Now, on a whole, this company A is responsible for to whom? It is responsible for reporting to all the stakeholders. Now, stakeholders means the employees of the organization, suppliers of the organization, creditors of the organization, community, and the government. Now, reporting to government means what? Reporting to government is very simple. Whatever rules and regulations are there, which are being made by the government in the form of various acts, various rules, various laws, that is to be fulfilled by the company. And that is what companies reporting is. Reporting to suppliers means that when the supplies are made by the supplier, whatever is due to the supplier, that due is to be cleared within a stipulated period of time. That is the responsibility towards the supplier. Now, the responsible reporting to the communities or customers is what? That whatever the product of the organization which is being manufactured, or if the organization is a service organization, so whatever service the organization is offering, that service or that product should be of good quality. So that is the model of uh, Anglo American corporate governance. This is how the American companies function. Now the next one is the Japanese model of corporate governance. Under the Japanese model of corporate governance is the shareholders. The shareholders here also they are considered as the owners of the organization. They make appointment of what? They make the appointment of supervision board. So there it is not called as board of directors, but there it is called as supervision board. So the main role of the board is to observe, is to supervise whether the company is functioning properly or not. Next comes is ratification of decisions and consulting. Now, their role, the role of the supervision board, which in other countries is called as a board of directors. The supervision board is supposed to do what? Ratification of decision and consulting. Now, ratification of decision, we had already discussed in SEM 1 under legal aspects of business. Ratification of the decision. Ratification means sanctioning the decision, approving the decision. Decision of what? Or decision of whose decision they are very approving or sanctioning. So the decision which is taken by the CEO or the management of the organization. Whatever important decision the management has taken, it is to be approved, it is to be ratified by the supervision board. Company has decided that it will go for expansion. The company is manufacturing four-wheelers in Japan. Now the company decides that it will also start its manufacturing facility in India also. The company is going for expansion because the company feels that there is a very good market, a very vast market in India. And if they start manufacturing four-wheelers in India also, they will be getting more benefits. Keeping in this mind, the company comes up with a decision. Now, this decision has to be approved by the supervision board, then only it can be implemented, otherwise not. So, first, and if they approve that decision, the supervision board, then it will be known as ratification of the decision, right? So the board's role is to ratification of decisions and consulting. Not only they are sitting there in the supervision board, the directors sitting in the supervision board, they are not supposed to only approve the decision or reject the decision or suggest changes in the decision, but they do have other important role, and other important role is the role of consulting. Consultant, we all are aware of. Consultant is an expert in a particular field. When a company wants to start some activities which are related to robotics, which are related to robots, which are related to artificial intelligence. So before starting that activity, generally what the company will do is they will try to find an expert in that particular field, and they will try to seek the suggestion of that expert. So that expert who gives suggestion to others, that is called as consultant. So two important functions are given in the Japanese model of corporate governance to the supervision board. First one is that they can approve the decision, that is ratify the decision. They can suggest changes in the decision, or they can reject the decision. That is the first job they need to perform. And their second job is that they can play the role of consultant, because on the basis of their expertise, on the basis of their knowledge in a particular field in which the organization is carrying out its business activities, they are appointed by the shareholders in the supervision board. Same as we had discussed in the previous session, that how board of directors are appointed, how independent directors are appointed, how non-executive directors are appointed. That we had discussed. That they are appointed only on the basis of their knowledge, on the basis of their skill, on the basis of their expertise, on the basis of their previous track record. They are included in the board. The same rule is followed in the Japanese model of corporate governance, also, same procedure. Now, as this supervisory board or supervision board is having experts, now they can play the role of consultant also. That when the company comes up with a decision that they want to go for expansion and they want to start a manufacturing unit in India too, the company, before taking the decision, they can do consultation with the supervision board. And supervision board can suggest, can provide good suggestions related to this particular decision, whether the time is correct for the investment or not, what are the existing rules and regulations which are to be followed by a foreign company who intends to start manufacturing of four wheelers in the country. If electric four wheelers are to be started, are to be manufactured, what are the conditions? If diesel vehicles are to be manufactured, what are the conditions? If petrol vehicles are to be manufactured, what are the conditions? Because the condition varies. The rules may be different in India, the rules may be different in China, the rules may be different in other country. So this supervision board can provide good suggestion, good consultancy to the executive board, to the management, executive management of the organization. That is their second important role. So that is, they have to, the supervision board has to perform the duties of ratification and of decision and consulting. The president, then there is a president of the supervision board. His role mainly is of consulting. Then comes the board of directors, which is the CEO of the organization. Then comes the management evaluation and operational activities. Now, what is the job of CEO? We have seen the job of the supervision board. Then their job is ratification and consultant. Then what is the job of the CEO of the organization? So the job of the CEO of the organization is management and evaluation of operational activity. Management here means the day-to-day management of the organization. How it will be carried out in the organization, that is to be taken care not by the supervision board, but it is to be taken care of by the CEO of the organization. First one is management and evaluation of operational activities. So they are very clear, not only managing the day-to-day business activities that are carried out in the organization, but also evaluation of operational activities. Evaluation of operational activities means how many people are appointed, how they are performing, whether the standard, whether the benchmark set for related to performance for the employees is constantly achieved by the employees or not, or regularly achieved by the employees or not. The raw material is giving the output which is expected or not. All these things are known as evaluation of operational activities. Whatever the operational activities are, they are to be regularly evaluated, constantly evaluated. And that is the job of the CEO of the organization. It should not wait for one complete year, that after the end of or after the completion of 1 year, we will carry out the evaluation, and then we will check which departments were performing well, which departments were not performing, or how many employees were performing well, how many employees were not performing well. So it is to be carried out not at the end of the year, but it is to be carried out in Japan every regular, regular. Now, regularly can be a week, can be fortnight, can be monthly. It depends upon the internal policy of the organization, but it has to be regular. It cannot take place after the end of a year. Now, there also the role of government is involved, and the role of government is formal or informal representation. Now, who will be making the formal and informal representation to the government? It is not the supervisory board, but it is the CEO of the organization which will be making the formal representation to the government. And the company can, if they want to raise the capital, there is a loan provision provided by the financial institutions. And mainly, these financial institutions are the banks which are operational in Japan. So, this is how the Japanese model of corporate governance works. Now, the next model is the German model. Now, the two models which we had seen, they are more or less on the same lines. The name is Board of Directors in Anglo-Indian of the highest authority, whereas there is change in name, Supervision Board in the Japanese model of corporate governance. But rest more or less, there are not drastic changes. But when we compare it with the German model of corporate governance, there are changes. What changes are there? Or there are more changes than the previous one which we had discussed. And what are those that we will be discussing? Now, here, employees and labor union, shareholders or owners. Here also, shareholders are considered as owners, but but the main change here is that they can appoint the supervisory board with 50% of members. The remaining appointment of the supervisory board is to be done by the employees and labor union. That is the most important change. In the first two, we had discussed that shareholders, who are also called as owners of the organization, as they are holding the shares of the organization, so they have the authority, they have the right that they can elect the members at the supervisory board or at the board of directors, supervision board and board of directors. But here in German model of corporate governance, the appointment is to be made on a different note, and that is that employees and labor union of a particular company, they enjoy a right, that they can appoint 50% members or 50% directors on the supervisory board, whereas the shareholders can appoint the remaining 50% of members on the supervisory board. For example, if 10 members are on the board of a particular company in Germany, then 50% will be appointed by the employees and trade union of that particular company. And the remaining 50%, that is, five members, will be appointed on the supervisory board by the employees or labor unions of a particular company. And five members will be appointed by the shareholders of that particular company. So here, equal opportunity, equal authority, equal rights are given to both the shareholders and the employees. Same thing was not present in both the models which we had discussed earlier, as well as this right is not present when we will be discussing the next corporate governance model, and that is the corporate governance model of India. So that is the main change. Next is, then supervisory board makes the appointment. Appointment of who? The managing board. Here, the managing board is the executive management of the organization, which is carrying out the day-to-day functioning of the organization. That body is called as managing board, or in India, it is called as executive management. So their role will be what? So supervisory board will appoint the management. That means the senior officers, senior managers will be appointed by the supervisory board, and this managing board will be accountable to the supervisory board. So supervisory board is same as we had discussed about the supervision board in Japan and the board of directors in uh, Anglo-American corporate governance. So that is same. So here, appointment of senior officials will be done by the supervisory board, and the managing board or the senior officials of the organization, they are 100% accountable to the supervisory board. Next is independent management of operating activities. Independent managers. Independent managers means there is decentralization being practiced in the German companies. The senior managers or the executive management, they will delegate authorities to the department level, and department level will be given a complete authority that this is the target your department has to achieve. Now you prepare a strategy how you are going to achieve that particular target. At the end of the day, you have to see to it that the target is achieved. So this is the independent management of operational activities, and that is the and that is what is expected in the company which is implementing German model of corporate governance. Now, the next model of corporate governance is the Indian model of corporate governance. Now, the three models which we had discussed, the stages, the levels were very less because decentralization is practiced more in the three countries which we had discussed so far as compared to India. And the parties involved or the players involved in the functioning of a company are more as compared to the other three countries we had discussed so far. So here, government plays a very important role. And the major reason why the government is playing a major role in corporate governance in India is that in India, if rules are not strictly imposed, many of the companies are not going to go by the rule. And that has been proved by various scams. That the moment the government becomes relaxed or the government gives more autonomy, more authority to the organization, that very less interference will be there, very less rules and regulations will be imposed on the organization. The moment the fraud becomes active, more fraud starts taking place. To avoid such practices, the government, the government's role is very active in Indian system of corporate governance. So government plays what? Government plays a regulatory role. Regulatory role. It regulates what? Regulates the rules and regulations, regulates the procedures through which the company has to function. The guidelines are given to the organization, to every company, that these are the guidelines, these are the rules, these are the regulations, and these all are the acts which you have to follow while carrying out your business activities. So that is a very important difference here. Such strict regulation is not there in the previous three countries which we had discussed. So what government does is it appoints regulatory authority. Not only the government has made certain laws, certain acts. Earlier, Companies Act 1956 was there. But when various scams started taking place after India accepting globalization, privatization, and liberalization in early 1990s, the government at that particular time also rules were there, acts were there. But because of certain loopholes, these frauds started taking place. To avoid that, the government complete made various changes in the existing companies law of 1956. Then the government thought that it is not suffice. So government entirely changed, came up with a new companies law that was introduced in the year 2030. So various rules, regulation, everything was changed. New type of companies were introduced. Role and responsibilities, penalties, offenses, all these important things were included. But still, but still, the frauds were taking place. Now here, the government thought that there has to be a regulating authority. In India, it is not sufficient to prepare a law. That is not the end of job. Once the law is prepared, the government has to appoint certain regulating authority which is going to check that whether this law is followed or not, and that authority is called as regulating authority. Now various authorities are appointed in India which regulates. We all are aware of those activities, regulating authorities. Now, SEBI is one of the most important regulating authority. We all are aware of what is SEBI and what is the role and functioning of SEBI. Although everything is written in Companies Act 2003 and 13 and other acts which are related with the functioning of the company, but still the government came up with SEBI, with another. SEBI is not the only regulating authority. Other regulating authorities are also there, but SEBI is the most important authority. Now, the role of this authority is to check whether the rules mentioned in various acts are being followed by the organization or not. Now, same separate regulating authority or the number of regulating authority which are being created, which are being started, or which are existing in India is more as we compare to the other countries, right? Because the moment we see that no one is watching, there is a tendency that we do something which is not lawful. That is a tendency, right? So regulating authority, they are to ensure the everything, everything they will be regulating, right? They have mentioned in detail what they will be regulating is that uh, the suppliers should supply the raw material regularly, then in return they should get their payments regularly. All these activities which are to be regulated by the government. Why it is to be regulated by the government? Because number of instances have occurred, if government is not regulating, that company is not following. Same is not the case with the other countries, right? That is why will see that the diagram or the levels of corporate governance in India are more as compared to the other countries, right? Now we will come to the most important part, that of that here also shareholders are considered as owners of the company, and they appoint the board of directors, they elect the board of directors, and the board of directors are accountable towards the shareholders, that is the owners of the organization. The board of directors, they will observe or they will control the management of the organization. Now, manage what they have to do is strategy formulation, appointing and monitoring is the role to be performed by the management. By the board of directors. Management in return, what they will ensure here, they will ensure accountability and compliance. Now, this compliance word is missing in other countries, which we had discussed. It is there in India, and the word means other in Japan, in Germany, in US. What we have seen is that the management is accountable towards the board of directors or towards the supervision board, but we have not seen the word compliance existence there. Why this particular term is included in India? Because accountability is one thing and compliance is another. Of course, when the board is electing or when it is appointing the senior management of the organization, management has to be accountable towards the board of directors and board of directors towards the shareholders. That accountability has to be there. That is for sure. but accountability should also be with compliance. So not only accountability, but the management should be uh, doing compliance activities also. What are the compliance authorities activities? So compliance is carrying out the statutory activities which are mentioned in various acts, and that is called as compliance. For example, very simple examples are there. If the law under Payment of Wages Act says that the salary of the employees of the organization should be credited in the account of the employees before 10th of the month, 10 तारीख से पहले सैलरी एम्प्लॉय के बैंक अकाउंट में जानी चाहिए. If this is the rule, the company has to comply with it. And in India, to ensure that compliance is made, there are certain procedures, there are certain formats which the company has to fulfill. They have to fill that particular format and submit it to that particular regulating agency that yes, in our company, we pay the salary of the employees before the 10th of the month. Then PF, Provident Fund, whether the company is deducting the Provident Fund or not. That is one. Provident Fund is deducted from the salary of the employee. But whether that Provident Fund is being deposited by the company in the name of that particular person under a particular authority or not. Again, certain formats are there. Every company has to fill that format and submit it to the PF authority. That yes, in our company we are contributing this much towards the PF fund of the employee, and this much is deducted from the salary of the employee. So all these things, which if are neglected, although present in various laws, number of occasions the government has seen that various companies are not following those provisions. And to make it compulsory, they have included this word that is called as compliance. Compliance means it is compulsory on the part of the management, on the part of the organization to perform all the statutory commitments which are expected under various rules, which are expected under various laws. ESI benefit, employee state insurance. For that also there are certain deductions. That act is different. Provident Fund Act is different. Payment of Salary Act is different. Whether all these things which are mentioned in various laws are followed by the management or not, that is checked with the help of compliance. And for that only, there are certain formats, there are certain forms that are to be submitted within a due date. There is a due date mentioned under the PF Act 1952 that this is before this particular date, the company has to deposit the PF of the employees as well as its own contribution in that particular fund. And for that, they have to give an undertaking in by submitting a form. A particular format is there. All the that how many employees are there, how much amount has been deducted from their salary, what is the contribution of the organization, what is the total contribution of the employee, what is the total contribution of the organization, that is to be mentioned in that particular form, that form is to be signed by the senior um, uh, person, the senior official, that is to be duly stamped, and then it is to be submitted. Or nowadays online system has started, so with the help of digital signature of the concerned official, in soft also they can submit it, but it is to be approved. Digital signature should be there of the higher official, the concerned official. Then only it will be assumed that yes, the company is complying with the various rules and regulations. So this regulation part plays a very important role in our country. And the reason is that still many of the employees are not aware of their rights given under various laws. As they are not aware of their rights, because why they are not aware of their rights, but because they are not well educated. And it is assumed by the government that when they are not well educated, when they are not aware of their rights, it will be easier for the company to violate their rights. To avoid that violation of rights of the employees and violation of rights of the shareholders, the company come up has come up with this, the government has come up with this particular word, that account, not only accountability is expected from the management towards the board, but what more is expected is the compliance part. So compliance plays a very significant role in India. Next is the society. We all are aware of that nowadays, one term is very prevalent, and that is CSR. So CSR, that is the corporate social responsibility. When this particular term was introduced in India, corporate social responsibility. The social responsibility means responsibility of the company towards the society. That is what is the simple meaning of corporate social responsibility. So when this was introduced in the country, compulsion was not there. It was not compulsory that every organization has to invest in a particular amount, a particular percentage from its profit in carrying out the activities for the upliftment or for the development of the society at large. That was not compulsory. When this concept was introduced, later on the government realized that very few companies are spending that particular amount which is expected out of their profit for the development of the society. And that was the reason why government has come up with the compulsion part. Now, you all are aware that now it is not voluntary, but now it is compulsory. Earlier, it was voluntary. That it is your responsibility. That should be done voluntarily by the organization. You have earned a profit of, say, 10 crore, 20 crore, 30 crore, 100 crores, or more than that. So, from that particular profit, some percentage, a very small percentage, 2%, 1%, 3%, whatever is mentioned, that percentage you should invest in uplifting the members of the society. Social activities, we have seen that many companies are involved in, say, making of the concrete road, or they come put up the street lights, or they make schools, hospitals, playgrounds for the children. So all this comes under the corporate governance activities. Sorry, social responsibility, corporate social responsibility activities. Now here, now the government realized very few companies are investing that particular amount from their profit. They are not ready to share a small part from their profit. So it made the government made it compulsory, and that is why it is said that the Indian law is more regulating than the other countries, because in other countries the companies themselves are coming forward. We have number of examples. So the number of examples in other countries are more. The number of examples in India voluntary involved in corporate governance, corporate social responsibility type of activities are very less. To make it right, the government has now come up with the word compulsory. Again, it comes under compliance. That you have earned this much of profit, show us how much of profit, how much percentage from that particular profit you have incurred on the development of the society under the CSR activities. That they need to prove. Then the customers also plays an important role, and then the labor also plays a very important role. Role of what customer expects, very simple, is there, what are the expectation of the customers? They expect good quality of goods and services. So if the company is into manufacturing, or if the company is to provide services, those services of good quality, those goods should be of good quality. That is what is expected. Then capital market, we all are aware what is the role of the capital market. Then the last one is production, skills and knowledge, wages, better work environment, and job satisfaction for employees. How the middle level or lower level employees are uh, included in the organization, appointed in the organization, that we all are aware of, on the basis of skill, on the basis of output, on the basis of knowledge of a person, particular person, the person is included, appointed in the organization. Now, in return, what the employees are expecting from the organization, they are expecting better wages, better work environment, and better job satisfaction. That is what they are expecting. So, in India, not only it is restricted to shareholder, board of directors, management, but it includes government, it includes customers, it includes employees of the organization, it also includes the other stakeholders, for example, the suppliers. So all inclusive, it makes the corporate governance in India. So it is a very exhaustive model, a very wide model, which includes uh, all these levels, all these customers are also included, government is also included, regulating authority is also included. So it is all inclusive, or it is also called as exhaustive or all inclusive form of uh, corporate governance, or model of corporate governance that is being followed in India. So now the next which we will be starting is the theories of corporate governance. So as it is already 8, so we will stop here. So in the next session, we will be able to complete this theories of corporate governance in say 20-30 minutes. We will be able to complete it. So remaining part, we will start with the unit number 5, that is the case studies. So come prepared for two very simple and very famous case studies. The first case study you need to come prepared is related to Kingfisher Airlines. So come prepared with a case study related to Kingfisher Airlines, and the other state case study which you need to come prepared is related to Chanda Kochar and the ICICI Bank. Right. So two cases we will be discussing in the coming session. Once we complete this agency part, then we will discuss. So the Chanda Kochar ICICI Bank case, you need to come prepared. And the second one is the Kingfisher Airlines. Right. So thank you everyone for being present in today's session. Thank you.
Sir. Sir.
Yes.
Sir, I want
Hello.
to ask you about something. When I can call you? At what time you will be free today?
Today after 10:30. 10:30 to 11 I'm free. Then again 11 to 1 I have two lectures. So
Okay, sir.
10:30 to 11 you can give me a call. No problem.
Okay, thank you.
Okay, beta. Chalo, bye.